I cannot tell you how often I speak to people in the investing business and they love investing, but they are constantly bogged down by the business. Today's sponsor, Ridgeline, was built to solve these pain points. They have built a real-time modern operating system for investment managers. It's everything from trading, portfolio management, compliance, customer reporting, and a lot more. It's all in one cloud platform. Again, it's updated real time, and it's ready to serve. I seriously wish this was around when I was working and spending those quarter ends compiling from every legacy system we had. And with AI adoption and digitization, the cost of standing still has never been higher. We're coming up on year end. It's worth reaching out to Ridgeline to see what the experience can be like with a single platform. Head to ridgelineapps.com. That's ridgelineapps.com. And there's a link in the show notes. And we're going to play a clip from Patrick O'Shaughnessy's conversation with Katie Ellenberg. She's head of investment operations and portfolio administration at Geneva Capital Management. Katie and her team at Geneva went live on Ridgeline in just 6 months after signing the contract. You'll hear a short clip here, and then stay tuned for after the episode where Katie shares the full story on choosing Ridgeline and how she benefits most from the offering.
We were using our previous provider for over 30 years. We had the entire suite of products from the portfolio accounting to trade order management, reporting, the reconciliation features. I didn't think that we would ever be able to switch to anything else. Andy, our head trader, suggested that I meet with Ridgeline, and they started off right away, not by introducing their company, but who they were hiring. And that caught my attention. They were pretty much putting in place a dream team of technical experts. Then they started talking about this single source of data. And I was like, what in the world? I couldn't even conceptualize that because I'm so used to all of these different systems and these different modules that sit on top of each other. And so I wanted to hear more about that. When I was looking at other companies, they could only solve for part of what we had and part of what we needed. Ridgeline is the entire package, and they're experts. We're no longer just a number. When we call service, they know who we are. They completely have our backs. I knew that they were not going to let us fail in this transition.
This is Business Breakdowns. Business Breakdowns is a series of conversations with investors and operators diving deep into a single business. For each business, we explore its history, its business model, its competitive advantages, and what makes it tick. We believe every business has lessons and secrets that investors and operators can learn from, and we are here to bring them to you. To find more episodes of Breakdowns, check out joincolossus.com.
All opinions expressed by hosts and podcast guests are solely their own opinions. Hosts, podcast guests, their employers, or affiliates may maintain positions in the securities discussed in this podcast. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.
This is Zack Fuss, and today we're breaking down Fastenal. Starting as a small fastener retailer in Minnesota, the company has evolved into a mission-critical supply chain partner for its industrial customers. Today, the business sports a nearly $50 billion market cap and produces nearly $8 billion in sales. The impact of Fastenal's founder, Bob Kierlin, on Fastenal's commercial success can't be understated. The industrial vending machine was his original idea, a vision he made a reality years later. Through its network of local branches, on-site locations embedded with customers, and innovative inventory management technologies, Fastenal has CAGRed at over 8% annually, far outpacing the industrial economy that it serves, and produces returns on capital exceeding 30%. Today, we'll unpack the strategic choices and cultural DNA, as well as the relentless customer focus that have fueled Fastenal's remarkable ascent. To break down Fastenal, I'm joined by Delian Entchev, a portfolio manager at Aoris Investment Management. We hope you enjoy this conversation.
All right, Delian, thank you for joining us to break down Fastenal. It's one of those fascinating businesses in that it's this powerhouse, a $40 billion market cap industrial distributor that I think outside of people who work in the industry that they serve and a loyal cult of industrial investors, it's not as well appreciated as a business, despite the fact that it's been an incredible shareholder return and growth story. The business's history comes from humble beginnings, and it's really a founder story. And so I thought maybe to set the stage, if you can provide us with some of that context around the size and scope of the business and the key things that are important to note as we dive a bit deeper here.
Yeah, sure, Zach. Let me start with what the business does. For those that aren't familiar with Fastenal, it's commonly described as one of the largest distributors of industrial supplies in North America, particularly. But I think that actually understates what the company does, why it's in business. It doesn't just ship boxes from A to B, as you might associate with a distribution business. I would actually describe it as more of an outsourced procurement function for its customers. It's a supply chain partner that helps its customers manage their inventory more efficiently. And I might bring that to life with an example. You might be surprised to learn that Amazon is actually one of Fastenal's largest customers globally. You might think Amazon's really good at shipping things from A to B, so why does it need Fastenal's help? Well, Amazon's warehouses, they need a continuous upkeep of things like cleaning supplies, components to maintain their equipment like the conveyor belts. They need safety equipment for their staff like gloves and goggles and earplugs. And Fastenal makes sure that Amazon always has a supply of these products on hand, so Amazon can focus on doing what it's good at. So Fastenal makes sure that customers always have the parts they need. Even one missing screw that you need to repair a machine can hold up your whole manufacturing line, so that's important. It can relieve customers of the burden of having to source products themselves and replenishing their inventory. They can just focus on doing their job. And it manages all the inventory for its customers. So even if it sits at the customer site, it's on Fastenal's balance sheet, and it means the customers require less capital. And finally, it can help customers analyze the usage of their supplies and try and reduce wastage and theft. It can attribute usage to certain projects or employees and help customers monitor that. So you can see that it's more of a service provider. It's not just distributing things from one place to another, although it does that very well, of course, as well.
And so I think at the most basic level, it's crazy to think that this is a business that provides essentially nuts and bolts to its customers. I guess there's been a pretty rich evolution in the business, and we'll go through the history, but can we just talk about how they went from a retail concept to one that's more integrated with their customers and how they operate within their customer ecosystem?
Yeah, sure. The business was founded by a man called Bob Kierlin and 4 of his friends in 1967. And Bob's father actually ran an auto parts store. And Bob was quite entrepreneurial. He noticed that some of the common parts that customers purchase regularly are fasteners, which are screws, nuts, and bolts. And he noticed 2 things. Firstly, that these components come in all sorts of different permutations, and his father couldn't possibly stock all the fasteners that the customers might need in his store. So they had to go around to lots of different shops to get all their needs. And secondly, he noticed that these nuts and bolts come pre-packaged in standardized boxes around the size of a cigarette packet. And he had this idea of using vending machines as a more efficient way to distribute the fasteners. So he wanted to set up this retail store with no staff, just rows and rows of vending machines, allowing them to stock more parts in the store, and customers can come in and vend their things automatically. So that was the original business idea. And as many startups end up doing, he had to pivot a bit because he found out very quickly that the vending technology at the time wasn't ready. It couldn't deal with the different sizes of the nuts and bolts. It couldn't attribute the purchases reliably enough, and it was a pain to restock. And so he pivoted to setting up his own retail store, but one that's only focused on selling fasteners. So he wanted to stock the broadest range possible of fasteners. It's like a one-stop shop. That's where the company name comes from, Fastenal, to help customers fasten all kinds of things. And he set that first shop up in this town called Winona, where Fastenal is still headquartered. It's got a population of about 26,000. It's this tiny town. Fastenal is the biggest employer in the town. And from there, the original concept was serving local people. It was more like a hardware store. So targeted at the general public, at contractors, at farmers who need to repair their tractors and other equipment. And what they found is more and more business customers were coming into the store. So customers that operate mechanics, customers that operate manufacturing sites. And they were willing to pay a premium price for availability that Fastenal just had these products in stock in one place. And they also purchased in greater volumes, which was more lucrative. And so pretty quickly they pivoted to serving business customers and local manufacturing businesses especially. And then from there, none of the founders really knew much about manufacturing. And they made a habit of asking their customers about their business, understanding their needs. And from day one, there's this culture of the business that's rooted in customer service, understanding what your customer needs and serving those needs. That's one of the internal mottos, growth through customer service. Even today, over 70% of Fastenal's employees directly serving customers, things like managing their sales account, providing advice, or restocking inventory at the customer side. How did they grow the business from that one store in Winona? They hired ambitious young people to manage the stores. They wanted people that were hungry to grow their business. They didn't give them much. They just gave them some inventory of these nuts and bolts, a desk and a chair, and they said, off you go. You can run it like your own business. You're responsible for your own P&L. And that culture of believing in its people, empowering its people, that's been a key contributor to Fastenal's long-term success. It's a business of entrepreneurs. When people have a problem, they don't just wait for approvals. They don't get told what to do. They have to fix it themselves. And Bob Kierlin, the founder, he wrote a book called The Power of Fastenal People. In that book, he wrote about what makes Fastenal special. And he says, ordinary people can achieve extraordinary things if they're given the opportunity. And that's what Fastenal is all about. The company will tell you, if you speak to them, that 95% of their branch managers and above, including the executive team, were internal promotions. So these are people that generally started as a graduate or a part-time employee, and they've been given more and more accountability over time, and they've proven themselves, grown their careers with Fastenal. And it's common to find people that have worked there for 30, 40 years plus. It's that kind of organization.
It's funny, in the last conversation that you and I had, we discussed Cintas, which in many ways culturally seems to have some parallels. You gave us some examples of the difference in culture here, but it seems like everything comes back to a degree of frugalness. I think in that article that you cited, The Cheapest CEO in America, it talks about the fact that Bob himself would only buy $60 suits. He would famously, I think the CEO and CFO share a hotel room when they travel. I don't know if that's still the case, but can you just speak more about that culture and how it's differentiated?
I think it's important not to confuse frugality with stinginess. So it's not a company that cuts corners or doesn't invest enough. It's not a company that's focused on expanding its own margins at the expense of customer service. Frugality is all about treating the company's money as if it's your own. And that's why, believe it or not, even today, the CEO and CFO sleep in the same room when they travel. It sends a message from the top down that you want to act as an owner of this business. And most Fastenal employees are actually shareholders in the business. On the other hand, the company, by being frugal and earning high margins, it allows them to invest more in their distribution infrastructure, in their technology, in their people, to improve its service proposition. So it's this virtuous cycle that actually running lean and being more profitable allows Fastenal to grow faster. Another example is that by having a leaner cost base, Fastenal can afford to operate in smaller markets where its competitors can't. Winona, Minnesota, I mentioned it has a population of 26,000. And Fastenal has multiple branches there because it can support a lower revenue base per branch with a lower cost base per branch. So it's a real advantage for the business. And again, I don't want to leave you with the impression that that's about cutting costs, cutting corners. I think Bob Kierlin, the founder, he's the one that instilled this frugal culture, and his legacy and influence is still quite strong in the business. So if you read one of their annual shareholder letters, management often refer to these founding principles. Bob himself actually still goes into HQ a few times a week. He lives in Winona. So he chats with employees, he offers advice, he writes internal memos to congratulate employees. But this is really driven from the top down. People know what's expected of them, but they also know that it's a business they can work for 30, 40 years. They can build a career, and the sky's the limit. It's just how much they're willing to put in.
And so from the humble beginnings in the 70s, a one-store shop, I think today it's a business approaching $7 billion in sales. I'd love to dive a bit deeper on the size and scope of the business and its financial profile, from top line to bottom line, what sticks out to you and how you think about the compounding of earnings going forward?
Sure. So let's dive into how it evolved from that one retail store. So as I mentioned, they began expanding the retail network, and they initially were single employee stores. They expanded from there, and from that one branch at its peak, Fastenal had about 2,700 branches, close to 3,000 branches. Each of those served their local markets. Even though Fastenal has some national, even multinational customers like Amazon, they still serve local sites. It's the local warehouse manager or factory manager that chooses who its suppliers are. And so Fastenal has to win at the local level. The next way the business broadened out and grew is by expanding the categories of products it sells. So it worked out, okay, people need screws, nuts, and bolts, but every fastener needs to be applied with a tool. So it started selling tools as well. And then what are other products that customers need to purchase regularly? Safety equipment, janitorial supplies, metalworking tools like wires and pipes. So it's a much broader business today. Fasteners, just a third of revenue, even though that's the foundation of the business. The next thing is, okay, well, we've got these branches, but is that the best way to serve our customers? And what Fastenal's done really well is keep coming up with new ways to deliver its services. As I mentioned, it's not just about shipping things from A to B. It's about how can we simplify and help customers reduce costs in their procurement function. So in 1992, it opened what's called an Onsite, its first Onsite within a customer facility. This is really important. So Onsites are where there's a full-time fastener employee working in the customer's site. They attend internal meetings. They're always around and available to help the customer with any problems around sourcing and supply chain. And they make Fastenal more deeply embedded in its customer. They can come up with more solutions to their business needs. It's a deeper relationship, and it makes it easier to expand its share of customer spending. If you're there every day, you know what else customers are buying, what else you could do for them. So the business mix has changed quite a bit, actually, the last 10 or 15 years. Over the last decade, Fastenal has actually closed about 40% of its branches. Now think about, I guess, how adaptable you'd have to be to make that change. This is how you were growing your business, by growing your branch footprint. And one day you decide, actually, there's a better way to serve my customers, and I'm just going to hit reverse on what I was doing for a few decades. Meanwhile, the number of on-sites they have today exceeds the number of branches they have. And these on-sites represent 40% of the company's revenue today, up from about 10% a decade ago. The company thinks it can grow the number of on-sites from about 2,000 locations today to 15,000 over time. So there's still a long runway to grow that service line. That's how it serves the customer. And then the question is, what's the best way to get products to a customer? How can I simplify their replenishment of their inventory? And it created its own solutions there. These products weren't available in the market before then. So one of those is called Fast Bins, where it uses weighted scales, RFID or Bluetooth technology, like you might find in one of those automated Amazon Fresh stores. So it can detect when a bin with supplies is running low, and it alerts the local Fastenal rep or the on-site rep, if there is one, to restock the site. So the customer doesn't have to touch anything. That bin is always replenished with the supplies. It might be a screw, nut, or bolt that they need. Then in 2004, after they'd tried a few iterations, Fastenal finally cracked the code on industrial vending machines. They actually acquired the company a few years ago that made those machines because they saw it as a proprietary advantage. So they finally managed to fulfill the vision of Bob Kierlin. And today, Fastenal's the largest supplier of industrial products through vending machines. And it's a great solution. Not every product is suited to vending, but for larger SKUs like safety goggles, like coils of wire, things that can be vended easily, it allows the customer to attribute purchases to a particular employee or project. It cuts down on theft and wastage because it's not out in the open. And again, it's the Fastenal rep that automatically replenishes those machines without any input from the customer. So today, its revenue from those automated replenishment sources is about 40%. So 40% of the business that isn't sold through the branches. So that's quite an important evolution as well. The final evolution, I guess, is opening international branches. It started in Canada in 1997. It now operates in Mexico, continental Europe, and across Asia as well. It expanded by following its customers in response to customer demand. So someone like Amazon has warehouses in Europe, in Asia. They really value Fastenal services, and they want Fastenal to help them make their operations more efficient in those other markets. So it's still early. That's only 17% of its revenue from outside the US, which is low relative to the share of GDP from those markets. So it's a large long-term growth opportunity. And I don't think there's any other business, any equivalent for what Fastenal does in these markets. I haven't found one personally. Maybe some have vending machines, but none have these outsourced procurement services the way Fastenal does it.
So can you just tie all of that together for us in terms of Fastenal's financial profile as it stands today?
So revenue in 2023 was just over 7 billion, 7.3 billion. As I mentioned, 40% of that is from on-sites. Just over half is served out of branches. Its EBIT margin is 20%. It's been very consistent, and it's an important internal KPI. As I mentioned, it's a frugal business. So branch managers and on-site managers, they're held accountable for their revenue growth, for their EBIT margin, and for their asset turnover and asset intensity. So the logic behind that is there's no floor once you start giving away your margin. So it's always tempting to sign an 18% business or a 15% business, and then a 10% business, and naturally your margins deteriorate. But the philosophy here is we want customers that value our services. They're willing to pay a premium for our services. They're not just buying products. They're also paying for our staff and our expertise. And so we should command a premium margin. And that's why Fastenal earns an EBIT margin 2 to 3 times that of other industrial distributors. And with the on-sites, they tend to be larger customers. The customer has to be large enough to justify allocating dedicated fastener staff to that location. And so those customers carry a lower gross margin. They get better terms because they're bigger. They have better bargaining power. But offsetting that, Fastener's operating costs on the offsites is lower. They don't have to pay rent for their facility. They don't have to distribute stuff through the branch and then to the customer. It can go direct to the customer. So it's a bit more efficient from an OpEx perspective. But at the EBIT line, it's the same margin on the on-sites as it does from the branches.
So what kind of strikes me is the way that they integrate themselves, not only from a services perspective, but also financially for these businesses, and that effectively they're providing working capital to their customers and financing the inventory and having it on their balance sheet. What is that basic financial model at play here that allows them not only to deepen their relationship and embed themselves, but also be effectively a business partner with the customers that they're servicing?
Yeah, sure. So Fastenal sell to customers based on a lower total cost of ownership. You won't find the cheapest price from Fastenal. If you just need one product, you'll probably find a cheaper price from peers like Grainger, maybe local distributors, and maybe even online retailers. So that is not Fastenal's proposition. But its proposition is you don't have to be the one that has to go out and find the product. You can be assured that we'll always have it in stock for you. And we can also help you analyze the stuff you use and make your own operations more efficient, even beyond what Fastenal does for you. It's almost like a consultant. So I can give you some examples, which I think can bring this to life. So it believes that for its average customer, it saves them about 20% on the total cost of managing their inventory. And they analyzed their customer accounts over a 3-year period. They found on average Fastenal reduced the customer hours spent on procurement and distribution by half. It reduced the value of inventory that customers had to hold by 37%. And again, that sits on Fastenal's own balance sheet, not on the customer's balance sheet. It reduced the employee travel time in the customer's plants by over a third. So Fastenal can locate their bins and their vending machines in convenient places. They can help customers even reconfigure their manufacturing plants to reduce walk time. Again, this is part of the service proposition. For the vending machines, consumption of products from before they had vending to after they implemented vending at a customer is reduced by 20%. And it's not because the customer needs less of this stuff. It's because you get rid of waste and theft. If the employee knows that you're attributing the purchase to their own account. So again, this is not a business that's everything to everyone. Not every customer will value these services. Some businesses just want the cheapest price, and as long as they get it next day or even within a week, that's fine for them. But Fastener's not trying to serve those customers. It'll earn a low margin on those customers that have value with services, but it focuses on the types of customers and the types of products that value the differentiated service. There's an interesting statistic that came to light in one of our discussions with the company. So every year, about 120 new accounts sign up with Fastenal, and those are mostly individual facilities. So Amazon might be thousands of accounts within Fastenal. And of those, 72% are not doing any business with Fastenal 5 years later. And only 2% of new accounts every year ever grow into a meaningful long-term account for Fastenal, financially meaningful account. So they're very selective on who they service. If they've allocated employees to a customer site and the customer's not spending enough through Fastenal, same for a vending machine, there's no upfront cost to the customer. But if they're not putting enough spend through that vending machine, Fastenal will take it away. They told us that if Fastenal is not losing any customers, then it's getting too much away because they need to value its service.
I'd love to walk through a real-world example of how the Onsite business works in more practical terms. So I'm just thinking through, perhaps you have an example of an archetype of a single customer that we could use to illustrate exactly how embedded the Fastenal representative is in their customer and the day-to-day operations of what it looks like.
Usually they work inside a customer's facility. So they put a desk somewhere on the customer's floor. They attend all the internal meetings with the customer's employees. They're on a first name basis with them, and they're always available on site to help the customer with any sourcing or supply chain problems. Fastenal refers to the solution in, I guess, 3 buckets. The first is providing the experts, the people. The second is inventory. So Fastenal invests in inventory either on-site at the customer or somewhere local, like the branch or a warehouse close to the customer site. And that inventory is dedicated to the customer. It's customized based on what they use frequently. And as with all Fastenal services, it stays on Fastenal's balance sheet until the customer checks out the item. And the final pillar is technology. So that's technology to dispense items, to monitor and control supplies. That can be anything from RFID bins, or it can even be what they call Fast Crib, which is almost like a canteen inside that's managed by Fastenal's employees, and they can dispense supplies, they can cut metalworking tools and other custom components for the customer in that crib. And the other aspect of technology, which is becoming increasingly important, is to give customers data and analytics on their inventory availability, on what they're using, and recommending how they can improve their supply chain practices. And you mentioned, to give an example of an on-site facility, the trick with the on-sites is every on-site is different. Every on-site is customized for what a particular customer facility needs. And an Amazon warehouse in Sydney, Australia may actually operate quite differently to an Amazon warehouse in Seattle. And different customers consume supplies in different ways. For instance, some may not have the space on site for a vending machine, so the supplies are delivered instead from a local branch. Or it might be important for a specific component to be located close to part of the manufacturing line, and they manage around that. So no 2 on-sites are alike. But the key to the on-site is the proximity to the customer, the intimacy of the customer relationship. You have Fastenal employees that really act like your customer's employees, and they're there to help with whatever the customer needs. It's been quite an evolution. Basically, customers that may have been served out of a local branch previously, once they get to a certain size that justifies investing in dedicated people and inventory, and Fastenal will move them onto an on-site program. Doesn't always budget the way they expect. Some customers don't grow into those resources, so it's a test and learn process, but those on-sites have grown steadily over time.
When you think about those customer accounts and the importance of choosing true partners, I'd be curious kind of like what an average account looks like, the amount of business they're doing. If you have a sense of if there's some extremely large accounts that are just the 80-20 rule, or is it pretty normally distributed? What does it look like? Am I doing $5,000, $10,000, $100,000 with them? I just am curious what the relationships are economically.
Fastenal has a very, very broad range of customers. And I would guess that even its largest customer, which is Amazon, would only be a low single-digit percentage of revenue at most. If I think about the average spend per customer, a good way to give you some context around that is that the average Onsite does about $100,000 per month of revenue. So that's dedicated to just one customer. So you can imagine the average customer spends a lot less than that per year. So it can afford to serve really small customers with its frugal cost structure. And the hope is that that spend grows over time. Maybe a customer expands into more of their facilities across the country. But you can imagine to justify dedicating a whole full-time employee to the customer, that has to meet that minimum spend for it to make economic sense for Fastenal. At the branch level, and I mentioned there's still about 1,700 branches across the US, they earn about $200,000 revenue per month. So you might have a dozen or so customers per branch, some of those quite small, some of those a bit larger. And as the customer gets large enough to justify on-site resources, then a fastener will pull people out of the branch and give them to the customer. It's a really common sense approach. And as I mentioned, it's really down to the branch managers. They get to run the business as they see fit, whatever makes sense to them, whatever they think will be better for the customer and more profitable for Fastenal. So there's no one cookie cutter model. I imagine every branch might look quite different depending on the mix of customers in that area and how the branch managers decided to service them.
And so when you think about the relationship with their customers, clearly there's a bit of a secret sauce here, but the basic blocking and tackling is to service your customers well, have the parts available when they need them, keep inventory levels stocked. But how would you kind of distill that all down into what the secret sauce is behind their economic success?
I think the secret sauce for Fastenal is first its value proposition. It delivers real value for customers and they're willing to pay for that. And I think it's a good place to be in a world where the working age population is shrinking. In many developed countries, customers have to navigate labor shortages and inflation themselves, and they can outsource those burdens to fastening. They can help them run their supply chains more efficiently. So I think it delivers value, and that's what helps it grow. It has a reason to be, so to speak. I think its focus really helps, that it doesn't want to be everything to everyone. Its main peer, which is Grainger, stocks a much, much broader range of SKUs than Fastenal does. So Fastenal's selective about what it does. I think its culture is a real advantage. So empowering people to make whatever decisions are necessary to provide the best possible service to the customer. They're hungry to grow, to do more for the customer, and that's really special. I think Frugality is special. It creates business opportunities like operating in these small markets profitably. To put some numbers around that, I think about a quarter of the US population lives in cities with less than 500,000 residents, but Fastenal earns half of its revenue from those areas, so it over-indexes to these small towns and cities. And then there's lots of other local distributors that Fastenal competes with day to day. It actually doesn't come up head-to-head that much with the likes of Grainger and MSC. Sometimes it's tempting to limit competition to just what you can see in the public sphere, but day-to-day Fastenal's competing with local distributors. And they might also have relationships with a local branch. And most of its customers use multiple suppliers, and Fastenal's job is to maximize its share. But it has scale relative to those local providers in procurement. It can negotiate better terms with its suppliers. It can invest more in technology, things like the vending machines and the bins and online ordering systems, more sophisticated than what local distributors can provide. They can invest in a denser network of branches and on-sites, distribution centers. It operates its own trucks. They can get products to the customers quickly and reliably. It's having more control of its infrastructure and being closer to the customer. That's valuable. I think it benefits from its national, multinational reach. A local distributor probably can't serve a customer with the sophistication of Amazon. And today, about half of its revenue comes from national accounts. Fastenal is an approved supplier for all the customer sites in the country. It tries to win the business branch by branch, but it's on that approved supplier list. And these customers don't want to deal with thousands of different suppliers. So there's a limited number of distributors that can meet the needs of those national customers, and Fastenal is one of them. But it has to earn its customers' business every day. There's not really any contractual obligation the customers sign. They do agree on pricing, but customer spend can fluctuate. And that's what leads to this agile culture where Fastenal can disrupt itself, and it looks very different to how it did a few decades ago. And it may look different again 20 years from now. It may have no branches. I can see a future where it just has on-sites in the customer site and distribution centers for shipping customer orders, and it doesn't have walk-in branches. I can see that being the future. And that's actually how it operates its business outside the US, where it had the benefit of starting with a clean sheet of paper.
Just to better illustrate how powerful the economic model of this business is, I thought it'd be an interesting exercise to highlight how things have trended over the last, call it, decade. Obviously, there have been some speed bumps along the way given the pandemic, but just to really show just how remarkable of a business model this is from a purely economic standpoint.
So if you consider that Fastenal serves broadly the industrial economy, 70% of its revenue is from manufacturing businesses. At least in the US, the industrial economy has grown about 2 to 3% on a nominal basis, so below the rate of a nominal GDP growth. And against that benchmark, Fastenal's organic growth has averaged about 8% per annum, maybe even a bit higher, 8.5% per annum over the last decade. So really impressive and consistent outgrowth of the industrial economy, which comes from winning new customers and winning greater share of customer spending and doing more for customers, more services, greater variety of products, and so on. Interestingly, many of Fastenal's customers are grappling with labor shortages. A key proposition here is that Fastenal outsources some of these services, so it relieves customers the burden of having a procurement manager or someone restocking shelves. And those labor shortages have hit the industrial economy, these frontline workers, blue-collar workers, harder than other industries. So Fastenal's outsourcing of those employees is increasingly valuable to its customers, and it can charge a premium for that service. So that's the growth line. As I mentioned previously, its margins have been very consistent. Internally, the target is to keep a 20% operating margin, and managers are told, we want you to stick to that target. As soon as you lose the purse strings and lose some of your discipline around margins, then you start giving away business at uncompetitive rates. We also don't want you winning business where the customer doesn't value what we do. We provide customers a lower total cost of ownership, so they should be willing to pay a premium on the retail price of the product, given it incorporates all these other services within that price. So that 20% margin they've been very disciplined with, and even through industrial downturns, they've held that level. So you can almost draw a straight line through the operating margin over the last 10 years. And as evidence of the value that Fastenal provides, it's large to publicly listed peers, which are Grainger and MSC Industrial. Their EBIT margins range from about 10 to 15%, and they're really the largest peers in the public domain.
I'm curious, whether it be market share or expanded services, what are other paths to growth for a business like this? And what are some examples of things they have done to broaden the addressable market in a way that means that there's a lot more to the story?
It's a good question, Zach, because it serves a very fragmented market, even in the category that it's best known for, which is fasteners. The company only has a 7% market share in the US, let alone overseas. There's still so much room for Fastenal to grow and grow in excess of the industrial economy by signing new accounts, by growing its share of their spending. Most of its customers use multiple suppliers, so Fastenal can demonstrate it does a better job and can deliver a lower total cost of service. Then it should be able to grow its share of customer spending by broadening into new categories of products, by growing overseas. International is still only 17% of its revenue, still quite early in that journey. And I think many of its customers from the US that have operations overseas would value having the same service delivered overseas. And then beyond that, Fastenal can also grow with local clients as it establishes a relationship, sales force, people on the ground. So that's an exciting long-term opportunity.
And so one of the things I find is that when a company suggests that its point of differentiation is its people and its culture, as an outsider, it's tougher to really appreciate how that can truly be a point of differentiation. And so I was wondering if there's a way that you can best capture the more qualitative nature of what makes this business so special.
If you were to speak with the management team, the way they would describe Fastenal is is not one single business, although there's a lot that ties Fastenal together in its values and its mission, but it's more like a collection of 3,700 locations that's across branches and on-sites. And each of those managers has full autonomy to run their business, subject to the guidelines set around expectations for growth and profitability. So they're in charge of their hiring decisions, they're in charge of which customers they choose to serve, what business they choose to chase, what services they choose to provide, even what products they stock and provide their customers. I read a statistic that about 40% of revenue from Fastenal locations is not procured centrally. So it's actually the branch manager choosing what to provide its customers. If a customer really needs a TV to set up their conference facility or to have quality metrics show up on the manufacturing line, well, Fastenal will go and procure TVs for them. So really, it's whatever the customer needs. And that's inherent in the business from day one. When Fastenal set up its second store outside Winona, Minnesota in the 1980s, they gave the store manager $1,000 worth of inventory, an old recycled desk and chair, and told him to get on with it. And it was really his domain, how he grew that business. And then the managers are rewarded and incentivized commensurately based on the business outcomes that they can drive. So it's a business that empowers people to make decisions, to serve customers, and it's not the right model for everyone. So within the first 1 to 3 years of joining Fastenal, the attrition rate for new employees is reasonably high because that model doesn't work for everyone. Some people need more direction, more guidance, and that's fine. But once you stay with Fastenal for a few years, you stay with the business for life. And it's a deeply entrenched culture. It was one of the first businesses, it's something that's in vogue these days, but one of the first public US companies to build out a corporate university in-house. So there are 4 or 5 dozen staff that work full-time training employees. And last year, every Fastenal full-time employee received on average 25 hours of training at this university. So people can upskill, they can move into different areas of the business and work on something that's more interesting to them. They're really given the freedom to do whatever they think is best for themselves and for the business outcome. So that's quite special. And I think it's a lasting legacy of this culture that the founder instilled decades ago, which has persevered.
And so this is a business that produces a ton of cash flow. It's not particularly capital intensive. They've had little in the way of M&A historically. And if you look at the returns on capital that they have enjoyed, which exceed 30%, how do you think about the reinvestment runway here? And what do they do with excess free cash flow as it relates to a broader capital allocation strategy?
So in the same way that Fastenal's mission is to deliver simplicity to its customers, it likes to keep things simple in its own business. So it operates with zero net debt. It's all internally funded, its operations. It doesn't really make acquisitions. Largest acquisition it's made was acquiring its manufacturer of vending machines a few years ago, but that was small. So it's all organically driven growth. That's quite important. It means Fastenal can keep doing things its own way rather than having to accommodate, integrate the cultures of other businesses. It doesn't really repurchase its shares regularly. Every now and then, if there's a period of abnormal share price declines, management become a bit opportunistic with the share repurchases, but really it pays out most of its excess earnings as a dividend after accounting for staying business investment needs and growth investment needs. So its dividend yield is about 2% today, but really what you want as an investor is the growth in value of the business. That's what you're participating in, that 8% organic revenue growth. So yeah, it's about your confidence in the durability of that growth. That's what's going to make the business more valuable.
And then I guess as a corollary to that question, what does the balance sheet look like and how has the business financed itself historically?
It's always had a conservative balance sheet. Actually, its early history, it operated with a net cash balance sheet. It goes back to this frugal culture that we've been discussing. And today it has effectively zero net debt. So its debt is equal to its cash balance. And I expect that to continue. This is a no-nonsense, blue-blooded Midwest business. They recognize that they do operate in cyclical markets and they don't want the business to come under balance sheet pressure and for that to limit what it can do in a downturn. Yes, that's important for Fastenal to sustain that conservative balance sheet. It also allows it to be opportunistic in investing more in inventory through periods of supply chain challenges and build goodwill and market share gains with its customers. And the pandemic was a great example of that. Fastenal built more inventory not just of the stuff that it already did for customers, but it went out there and bought more COVID testing kits and hand sanitizer and face masks and whatever customers needed to help them stay in business and run their operations. It outsourced some of that burden for them, and customers were very grateful for that. So inventory grew about 30% between 2019 and 2022. But that's an investment they were willing to make, and they earned a return on it, both financially and through goodwill with customers.
And then if I look at a business like Fastenal, it candidly trades at a pretty aggressive multiple. I think the pushback typically would be their success is highly linked to the industrial economy and the cyclicality of it. How do you consider what the risks are here, and how do they try to defend themselves from those risks that are seemingly quite known and perhaps others that are less obvious?
There's no doubt that Fastenal is subject to cyclicality in its end markets. It serves the industrial economy, and in years where the industrial economy is soft, like in 2016, its organic growth was only 2%, quite a bit below normal. In years like 2024, where we expect about 3 to 4% organic growth, which is quite below normal. This is a slower year in terms of industrial activity. So there is some cyclicality in its revenue, but I think there's the expectation that it will gain market share every year. Its branch managers are incentivized to grow their business. They don't get bonuses if they don't grow. So even in the down market, there's always more we can be doing for customers. That's a really important mindset. And its revenue growth actually hasn't been negative a single year since the GFC, which understandably was an extraordinary event. And its margins are also incredibly stable. That EBIT margin of 20%, you can almost draw a straight line through it historically. And that comes from this discipline of only serving customers that value your services, not giving away on price. So even through cycles, it's been remarkably consistent in terms of its profitability. And I think it's become a broader business as well. It serves a broader range of customers with a broader range of products. It's slowly expanding internationally, so that creates some resiliency as well. But every business is subject to cycles. Every business inevitably goes through challenging periods that we assess the business on a through the cycle basis. It operates with a very conservative balance sheet, basically no net debt. So there's no scenario in which a cyclical downturn can meaningfully impair the long-term value of the business because of balance sheet stress. And at the moment, it's probably the slowest period Fastenal has seen since the GFC. They say that the US PMI, which is a survey of manufacturing activity, it's been in contraction for 22 of the last 23 months. But its revenue and earnings are much less volatile than what you're seeing in industrial production.
Our customary concluding question are lessons that can be learned through your studies of Fastenal and your experience with the business that could then be applied to other prospective investments, and also from the perspective of a company, what they can do to better emulate a business like Fastenal and improve their business. I give it to you to help us to better understand those lessons.
One interesting one for us was the value of candor and clear communication from management. And I think Fastenal really excels in this respect. In their annual letters, they even share snippets from their internal communications to employees. If anything is not going to plan in the business, if anything's changing the business, even if there's external conditions that have affected Fastenal's growth, they're remarkably transparent. In the last 24 months, Fastenal's management team, they've spoken openly on their quarterly earnings calls that anyone can listen in, that the sales processes for one of their services wasn't as effective as they'd like. They've made personnel changes to their sales force to address the issue, but they've told us that candidly. They've communicated the closure of the branch network and what implications that has for the business and how customers are served. They've been very transparent through that whole process. Every business inevitably makes mistakes and goes through challenging periods. And for investors, it can really test your confidence in the quality of a business, in the management team. Is this a cyclical issue or a structural issue? If the market, if the share price is telling you you're wrong, it can be really difficult to stay the course. And so it's been very valuable to us for a business like this to receive honest, balanced feedback on how the business is performing. And it helps us stay the course and make the right investment decisions through those periods. So that's been a really valuable lesson for us. We've had other portfolio companies where that hasn't been the case. Another interesting one is just the value of going out to visit these businesses in person. And in our case, that's from Sydney, Australia. So it's a long trek. But every time we've made the effort of going out to Winona in Minnesota, it involves a 3-hour drive down from Minneapolis. We've been given at least half a day of management's precious time. We've spoken to many of its executives and walked the floor of its distribution facility, packing facilities, and so on. And we've come away with a deeper appreciation of the cultural attributes of the business, of the service offering, just being there, seeing it in person. And funnily enough, you mentioned it's a $45, $50 billion market cap business. It's in the S&P 500. The CFO told us that the company only gets about a dozen or two investor visitors a year that bother to go out and visit them and learn some of these things. So I think there's value in scuttlebutt, we found.
I think after revealing that tidbit, they may get imbalanced for a few more visits, for better or for worse. Delian, we appreciate it. Fastenal is a fascinating business, one that's been an economic force over the course of the last, call it 40, 50 years. And clearly growth is going to continue at a steady pace, and they'll navigate the cyclicalities of the industrial end markets. But the way with which they're embedded with their customers clearly bodes well for their future success.
To find more episodes of breakdowns ranging from Costco to Visa to Moderna, or to sign up for our weekly summary, check out joincolossus.com. That's JOINCOLOSSUS.com.
We hope you enjoyed the episode. Next, stay tuned for our conversation with Katie Ellenberg, Head of Investment Operations and Portfolio Administration at Geneva Capital Management. Katie gets into detail about her experience with today's sponsor, Ridgeline, and how she benefits the most from their offering. To learn more about Ridgeline, make sure to click the link in the show notes.
Katie, begin by just describing what it is that you are focused on at Geneva to make things work as well as they possibly can on the investment side.
I am the head of investment operations and portfolio administration here at Geneva Capital. And my focus is on providing the best support for the firm, for the investment team.
Can you just describe what Geneva does?
We are an independent investment advisor, currently about over $6 billion in assets under management. We specialize in U.S. small and mid-cap growth stocks.
So you've got some investors at the high end. They want to buy and sell stuff. And you've got all sorts of investors whose money you've collected in different ways, I'm sure. Everything in between, I'm interested in. What are the eras of how you solve this challenge of building the infrastructure for the investors?
We are using our previous provider for over 30 years. They've done very well for us. We had the entire suite of products, from the portfolio accounting to trade order management, reporting, the reconciliation features. With being on our current system for 30 years, I didn't think that we would ever be able to switch to anything else. So it wasn't even in my mind. Andy, our head trader, suggested that I meet with Ridgeline. He got a call from Nick Shea, who works with Ridgeline, and neither Andy or I heard of Ridgeline. And I really did it more as a favor to Andy, not because I was really interested in meeting them. We just moved into our office. We didn't have any furniture because we just moved locations. And so I agreed to meet with them in the downstairs cafeteria. And I thought, okay, this will be perfect for a short meeting. Honestly, Patrick, I didn't even dress up. I was in jeans. I had my hair thrown up. I completely was doing this as a favor. I go downstairs in the cafeteria and I think I'm meeting with Nick, and in walks 2 other people with him, Jack and Allie. And I'm like, now there's 3 of them. What am I getting myself into? Really, my intention was to make it quick. And they started off right away by introducing their company, but who they were hiring. And that caught my attention. They were pretty much putting in place a dream team of technical experts to develop this whole software system, bringing in people from Charles River and FactSet, Bloomberg. And I thought, how brilliant is that to bring in the best of the best? So then they started talking about this single source of data. And I was like, what in the world? I couldn't even conceptualize that because I'm so used to all of these different systems and these different modules that sit on top of each other. And so I wanted to hear more about that. As I was meeting with a lot of the other vendors, they always gave me this very high level sales pitch. Oh, transition to our company. It's going to be so easy, et cetera. Well, I knew 30 years of data was not going to be an easy transition. And so I like to give them challenging questions right away, which oftentimes, in most cases, the other vendors couldn't even answer those details. So I thought, okay, I'm going to try the same approach with Ridgeline. And I asked them a question about our security master file. And it was Allie right away who answered my question with such expertise. And she knew right away that I was talking about these .old securities and told me how they would solve for that. So for the first time, when I met Ridgeline, it was the first company that I walked back to my office and I made a note and I said, now this is a company to watch for. So we did go ahead and we renewed our contract for a couple of years with our vendor. When they had merged in with a larger company, we had noticed a decrease in our service. I knew that we wanted better service. At the same time, Nick was keeping in touch with me and telling me the updates with Ridgeline. So they invited me to base camp. And I'll tell you that that is where I really made up my mind with which direction I wanted to go. And it was then, after I left that conference, where I felt that comfort in knowing that, okay, I think that these guys really could solve for something for the future. They were solving for all of the critical tasks that I needed, completely intrigued and impressed by everything that they had to offer. My three favorite aspects, obviously, it is that single source data. I would have to mention the AI capabilities yet to come. Client portal, that's something that we haven't had before. That's going to just further make things efficient for our quarter end processing. But on the other side of it, it's the fact that we've built these relationships with the Ridgeline team. I mean, they're experts. We're no longer just a number. When we call service, they know who we are. They completely have our backs. I knew that they were not going to let us fail in this transition. We're able to now wish further than what we've ever been able to do before. Now we can really start thinking out of the box with where can we take this? Ridgeline is the entire package. So when I was looking at other companies, they could only solve for part of what we had and part of what we needed. Ridgeline is the entire package, and it's more than that in that, again, it's built for the entire firm and not just operational. The Ridgeline team has become family to us.